Good morning to everyone. Thank you for taking time out of your busy schedules to join us today. We're going to be covering kind of a market investment update and other financial considerations that are important to investors in considering their portfolios. My name is Greg Estes. I am the Chief Investment Officer of MBI, and I'm going to be joined by Drew Culver today. Drew is a client investment advisor at MBI. He's responsible for managing client portfolios, overseeing investment strategies, and working closely with clients to align their portfolios with their financial needs. Very happy to have him join us today. So welcome to Drew.
Thanks, Drew.
MBI is the wealth management arm of Counselor Buchanan and Mitchell. We've been doing this for more than 10 years, helping clients achieve their financial goals, as well as managing their investment portfolios. So let's just give you a brief overview of what we're going to cover today. There are a lot of topics, so I don't want to spend too long on this, but we're going to be covering kind of what's been going on in the economy and market fundamentals from a high-level view. As well as talking about earnings outlook. This is very important. If you're investing in stocks, mutual funds or ETFs, you want to know about this. And then last, but certainly not least, is how do you approach your portfolio in a volatile market? So it's a huge consideration to think about. Okay, so no topic is, when you're talking about investments, no topic is complete without mentioning the Fed. So I always like to start off with a little bit of humor. I think one of the biggest hobbies among people that follow the Fed at all is criticizing the Fed. This idea that they're too late when they need to be acting faster, or they're too early when they need to be holding off on doing something. Pretty prevalent among people that watch the Fed. I think there's kind of another meaning to this cartoon at this point, and that is that with the government shutdown, a lot of data that might be coming out isn't coming out because the people that examine certain parts of the economy and release data, they're not working right now. So because of the shutdown. So in a sense, the Fed is sort of flying blind, not completely, but they're not getting all the data that they normally get. So it's a big issue. And we're going to be talking about the Fed more in a minute. But speaking of shutdowns, we've seen this situation before. The graphic you're looking at right now is showing you different shutdowns in the past and how the S&P 500 has behaved during those periods. And I think kind of the big takeaway here is that for the most part, the market is pretty agnostic to shutdowns. Incidentally, this shutdown will likely be surpassing the shutdown of 2018-19 as far as length. But, in that long shutdown, the S&P was up 8%. Since this shutdown started, I think the market is essentially slightly up in that period of time, but it's been volatile. So I think the takeaway here is, for the most part, markets are pretty agnostic to this. Their focus is in other areas that we'll talk about. All right, so how do we characterize 2025? I call it from the cellar to the penthouse. So if you look at the chart on the left, this shows you that earlier this year, the market was in a very bad place with the tariff announcements in early April. There was a 2-day slide that ranked in the top 10 for market declines just in this year, going all the way back to 1950. So that measurement period is pretty long, and you can see a lot of 2008s in there. That was an awful year, and there were a number of slides, 2-day slides, that rank in the top 10. But the fact that this April saw a 2-day slide ranking in the top 10 means the market was pretty apprehensive about those big tariff announcements. And yet, if you look at the chart on the right, the 6 months since the end of September, it's been one of the best 6-month stretches in the last 25 years. So we've gone from a big decline quite the recovery and increase in that period of time. So it's been a tale of two markets, really, if you think about it from that perspective. I do want to get back to the Fed. So kind of joking about the Fed flying blind, they have kind of they're stuck between a rock and a hard place. So they have a dual mandate. They're supposed to promote maximum employment while maintaining price stability. So I've got some characteristics of what these two mandates mean. So in the one, you're focused on the labor market. On the other, you're focused on inflation. The Fed sets rate policy, the short-term rate policy, the overnight rate that banks can lend to one another, the so-called Fed funds rate. So if that rate is too high, and that's kind of a term of art, but if that rate is too high, that can stifle job creation, but it can also bring down inflation. If it's too low, it does the opposite. It can encourage job creation, but if it's too low, it can also stimulate demand, which can increase, put upward pressure on prices and have an inflationary effect. So you can kind of see how these two mandates can operate in tension with each other. The current concern right now is really about the labor market, that the labor market is this canary in a coal mine. And if there's a problem with the labor market, that could signal bad news for the economy down the road. And what we've seen in most recent data, and there's a big asterisk there because some of this data is now not being released due to the shutdown. What we're seeing is that the job creation numbers are coming down. We're not seeing net job loss, but we are seeing a real slowdown in new hiring in the economy, and that's a concern for market watchers and for economists. So, what does the Fed do? Do they pay attention to inflation or do they pay attention to the labor market? And right now, the narrative from the market seems to be they're going to pay more attention to the jobs market and trying to support the jobs market. I think the curveball there is that the economy is still doing well, and we'll talk about that in just a minute. But so there's been a slowdown in new hiring, but if the economy is still performing well and you're cutting rates, are you then throwing fuel on the fire for inflation, which has remained relatively stubborn? It's a big question. Okay, so I mentioned, what the market's expectations are. They're expecting the Fed to cut the Fed funds rate. Currently, that rate sits at 4.25%. What this chart is showing you is based on Fed fund futures. The probability, at least from the market's perspective, is that the Fed will cut rates a total of 0.5% by the end of the year. So more than 90% probability of that happening. And the most likely scenario, if that were to occur, would be a 0.25% cut at the October meeting, which is coming up at the end of the month. They're off in November, and then another 0.25% cut for the meeting in December. That's the most likely scenario. Now, if that doesn't happen for some reason, we could see an injection of volatility into the markets because that would be somewhat of a disappointment given how much expectations are built in for these rate cuts. But again, another topic we're going to be talking about here is kind of a return of volatility in markets. Okay, so I mentioned that the economy is doing pretty well as a whole. Q2, which ended back in June 30th, performed above expectations and got revised upward 2 times after the initial number was announced. So the second quarter was above expectations. Q3 ended on September 30th, but we obviously don't get those results until later, and that might even be delayed further given the shutdown. But we do have a sort of estimate of how the third quarter growth might look, and that's the Atlanta Fed's measure called GDPNow, and that's in green. And what you can see is that estimate of growth for the third quarter is running well above economists' consensus expectations, which is that blue region, which is the expectations just north of 1%, maybe about 1.5% growth, the range between 0 to 2%. Now, the GDPNow number doesn't precisely match up with the actual quarterly results when they are reported. But it does give you kind of a sense for, is the economy still running pretty well? And it would appear, based on the GDP Now numbers, that it is. A different way of thinking of how the economy is doing is this economic surprise measure. So just to explain what that means, every data point that's released, there are expectations of what that number is going to be before it's released. And then you can compare that with the actual result once it's released. So for example, if we expect quarterly GDP growth to be 2.5% and it comes out at 2.7%, that's a positive surprise. If it comes below 2%, that's a negative surprise. So if you combine and measure all of these data releases and get a net positive or negative surprise, that can kind of give you some sense for how the economy is doing. And if you examine where we are today, that measure is reading at 8.9. So net positive surprises in the economy, and they've been that way really through since the start of the second half of this year. So basically starting in July. So pretty steady performance. The economy is still kind of exceeding people's expectations. To be fair, those expectations were moderated quite a bit with the initial announcement of these big tariffs. But what we've seen is that those initial tariff announcements were really large, and the results that we've actually seen have been lower than that. We still have tariff levels kind of in that effective range between 10 to 15%, but not nearly as high as we thought they would be in April. So again, kind of better than expected. Inflation, we keep monitoring this, and just to keep you informed as to what this is. So this is two measures of inflation going back to December of 2020. The red line is personal consumption expenditures. The yellow line is the consumer price index. And the way to read these is how much has inflation grown over the past 12 months. So you can see how high they were in 2022. And the Fed basically responded with the tool that they have, which is to increase interest rates. That's this blue line. So they rapidly increased the Fed funds rate to kind of slow things down and push inflation back down. And it largely worked, but you can see that those inflation numbers have kind of moved sideways. Ideally, there's kind of this rule of thumb that 2% is sort of a long-term healthy rate of inflation. And these numbers look like they were approaching that. Last year, the Fed decided to cut the Fed funds rate from 5.5 down to 4.5%. They've cut it once back in August to 4.25. Again, this was largely on the idea that maybe the labor market was slowing a little bit and they needed to support that. Comfortable with the level of inflation being a bit higher than what they would ideally want. So again, kind of siding on the side of supporting the labor market above pushing inflation down further. But where they go from here, they want to be data dependent. But again, if some of that data is kind of missing, it makes their job even more challenging. Okay, I wanted to kind of shift gears and talk about a pretty hot topic, which is gold. I've seen a quip that gold is the new Bitcoin. Certainly this year, it has been on a tear. So this chart is going way back to the 70s and showing you the price of gold, and it's doing it. You notice this vertical axis isn't evenly spread. It's a logarithmic scale. Why would you do that? Well, this way you can kind of see when the price of gold doubles. It's pretty easy to see that. And you can see there have been 3 periods where it's doubled or more than doubled. Back in the late 70s into 1980, when inflation was really rampant, gold had quite a performance. Then in 2010 to 2011, there was fear of a debasement of the dollar. In other words, the Fed their policy was so easy and with rates near zero and issuing lots of, buying a lot of treasuries and putting them on their balance sheet. That pumped a lot of dollars into the economy. So there was concern that there would be a debasement in the dollar. And then today, I guess the rationale is that gold might be an alternate reserve versus the dollar among other countries, and that there's this notion of shorter term inflation, primarily due to tariffs and due to the Fed now maybe getting easier on rates by cutting them to support the labor market. So clearly, gold has been on a tear. It's doubled this year, but I think it's important to put it in a long-term perspective. So this chart is going back to the late 80s, and it's showing you kind of how gold has done versus the total return in the S&P 500, which is in green. And you can see that gold is having its moment this year, and it's certainly had fantastic returns this year. But over a really long period of time, having a lot of exposure to gold may not be the best place for your money. As a matter of fact, if you think about it from a different perspective, really nothing beats owning businesses. So business value creation over a long period of time through earnings growth and increasing business values, which in turn increases stock prices, has really been a very fruitful area for an investor to be. I think of gold as a diversifier or a hedge in one's portfolio, but not necessarily should it be a concentration in your portfolio. Kind of along the same lines as we talked about gold, I do want to talk some about currency. So you can see different currencies and how they've performed this year through October 17th. And there's one big outlier, and that's the US dollar. So the dollar has significantly weakened this year. And if you are investing in international stocks, you may have noticed that in your returns. It's really boosted returns for US investors that are buying stocks denominated outside the US in foreign currencies. So what does this mean for you if you're a US investor and you're investing internationally? So even if you're owning a mutual fund or an ETF, that fund or ETF is buying stocks in another country, and they are denominated in a foreign currency. So you are essentially, not only are you owning shares of that business, you're buying a foreign currency. And if the dollar goes down, when you translate that investment back into dollars, you have more dollars simply because the exchange rate has gone in your favor. So having international investments, and again, I want to caution, as a diversification in your portfolio, as a diversifying element in your portfolio, has been beneficial this year because of this currency move. But the question I often get is, well, should I now buy international stocks because they've done so well? Well, I do want you to think about things in terms of currency movements. So going back into the 90s, how has the dollar done? And this is the dollar index. So it's measured against a basket of other currencies, and so you can see what's going on. And since 2010, the dollar has generally trended up, but if you look in 2025, you can see that big sell-off. Now, I'm not a huge market technician, and this is a chart that kind of is showing you these rising peaks and rising troughs and sort of a channel that the dollar has been in. And you can kind of see in recent history here that the dollar has bumped this lower bound and has bounced off it. So a lot of the decrease in the dollar value has actually occurred, in the first half of this year, and it hasn't really been occurring over the recent couple of months. So, should you put more money into international investing? Well, no one really knows exactly where currency is going to go, but it doesn't tend to just continue trending in one direction or another. It tends to move in a range. That's, I think, the big point here is that the dollar does move in a range. Currencies move in a range. The only time they don't move in a range is if you have a failing economy and it's in the decline and the currency continues towards, a lower bound of worthless. But in the case of the US economy, that isn't the case. And that's another thing I want to mention is, you know, currency values, they don't just exist in a vacuum. They exist, comparative rates, interest rates between different economies and the performance of different economies. And the US economy is still performing relatively well. So that does also offer some support for the dollar. Okay, so how have stocks done this year? I touched on it early on, saying that they've had really good performance over the last 6 months. But since the start of the year, let's look at, the performance of different indexes in the stock market. So the blue line, the Russell 1000 index, these are the largest, these are the large cap stocks in the US market. The red line, S&P 400 mid cap, these are mid-sized companies in the US. And then the green line are S&P 600 small cap, small companies in the US. So the red, blue, and green are all US, based companies. And then in purple, you have the all country world index, excluding the US. So everything outside the US. And you can, everything starts the year at zero. There's 0% return at that point. And you can see already before even the announcement in April, you have US stocks kind of declining on these concerns about what the tariff announcement might be. And then boom, you see that big 2-day slide in early April because of the tariff announcements. You actually even see it outside the US. So there are a lot of concerns about, you're going to slow down the economy, not just in the US, but globally. And from there, there's a recovery period as there's a kind of the realization sets in that these announced tariffs aren't necessarily what we're going to have. There are continued negotiations with other countries. Along the way in the summer, there's also data that points to the economy still performing well. And as I'll mention in just a moment, the earnings picture has been also pretty resilient. So what you see over the months, beginning really in May, is a recovery in markets, pretty strong market performance for international stocks, large cap stocks, kind of almost around 15%, and then mid and small kind of trailing. But, if you look in October, you do see this kind of downward, this V shape in some of these indexes. Again, so, volatility was really high in April, and then it subsided. Just to kind of measure what we're talking about with volatility, it's the level of bounciness in markets due to uncertainty. One way to look at that is called the VIX index, which is a volatility index. It measures kind of the spread in pricing between calls and put options, just to kind of give you a sense for how uncertain markets are. And you can clearly see that huge spike in early April when markets were highly uncertain. And what you see is that volatility measure started to subside in the summer, and in recent history, it kind of bounced again. Trump kind of casually announced a 100% retaliatory tariff on China, and that kind of led markets back into this volatile period. I think my big point to make here is that we could still see continued bouts of volatility going forward, whether that's due to trade policy or the Fed's stance on interest rates. I know they said the market's expecting 0.5% cut, but if that doesn't happen, I think you could also see volatility injected into the markets. So, volatility doesn't just go away and never come back. There are points in time where it can be re-injected, and it's usually something that's somewhat unexpected. Okay, so the earnings picture. How have corporate earnings been doing? This chart, it's got a lot of colors. It's just showing you the calendar quarters for this year and how much growth they've shown versus the previous year. So when you look at where a line is, that's showing you what the growth rate is for that quarter versus the prior year quarter. So for example, Q1 and Q2, those are over and done with. Q1, the blue line, and Q2, the red line. And what you see how they bent upward and now are flat. That's because they've already been reported. Whereas Q3 and Q4, we're just starting to see those results come in. So the way to read this chart is that the first quarter and the second quarter exceeded expectations. That's why you see this upward move in both of those lines. So the expectations were a lot lower, and then those results were a lot better than expected. I have question marks for Q3 and Q4. We can see kind of the level of expectation for earnings growth in these periods. So the third quarter, which ended at the end of September, kind of the expectations between 6 to 7%. They're now being reported. It's somewhat mixed, although I think the net results so far have been better than this level. So again, exceeding expectations. And we'll wait to see what Q4 looks like. But the net kind of takeaway here is that earnings growth in the S&P 500 has been better than expected. Looking at it a different way, this isn't really showing you earnings growth rates. It's showing you total operating earnings per share for the group of S&P 500 stocks, and it's doing it by year. So each line is a year. You see that bottom line, that bottom blue line is 2023, 24, 25, and 26. Obviously, 25 isn't over, and 2026 hasn't yet happened. The red line is the interesting one to follow. This is kind of the expectation at that point in time of what the next 12 months earnings are going to be. So you see how it keeps moving up. That's indicative of continuous growth in expectations for what the forward earnings per share is going to be in the S&P 500. Another point to make here is you see kind of this gap between 2025 earnings and expected level of 2026 earnings. That means growth, or higher earnings level in 2026. So this is all constructive for stocks. I know, it's not just about earnings growth, but earnings growth is important because that, as earnings grow, that grows the value of the business. And the stock price is essentially an estimate of what the value of the business is. So if you can keep growing your earnings, you're growing the value of your business. That should support stock prices. I am going to close my portion on earnings by just covering mid and small caps. We talk a lot about large caps. What about mid and small caps? So the upper chart, the S&P 400, those are mid cap stocks. And this is showing you back to earnings growth. So I know it's hard to make out the different years in the red lines of 23, 24, and 25. But what you can clearly see in both the S&P 400 mid caps and on the bottom, the S&P 600 small caps, is in all three of these years, kind of the expectations started out higher and those growth rates went down. And the way to characterize it is for each of these years is that 23 wasn't a good year for either. 2024 was better, and now 2025 is kind of showing growth in both categories. But I do want to leave you with this thought. The blue line, that's the short-term earnings growth rate. So looking ahead again for the next 12 months, and you can see that that growth rate has been increasing. So again, they've been kind of lackluster as far as earnings growth when you compare them to large caps, but it does appear that they are finally getting there, and that that they will also be showing more earnings growth, which is important for those right now. Those earnings growth rates at 15.4% for the S&P 400 mid, 16.6% for the S&P 600 small. That's positive for those categories as well. So this is just a reminder that it isn't all about large caps. You also need to have kind of a diversification in your portfolio. And before I go on about diversification, I do want to introduce Drew and have him talk about diversification and how we view volatility and how to view your portfolio in light of volatility. Drew?
All right, thanks, Greg. So on screen, it's a lot of colors popping out at you, but this is what we refer to as an asset quilt. So at the top of each column, you'll see a year beginning from the left from 2014 to the right, which is year to date. And then you'll see asset classes and their respective returns for that year. So in the top row, it was the best performer that year, and then going down, it gets worse. So for instance, year to date, international emerging market has been the best performer, and cash has been the worst. However, if you look at 2018 to 2022, international emerging markets were the worst performers 3 out of those 5 years. So it can be extremely difficult predicting which asset class is going to be the best performer each year. But if you look at that balance line or box, which is the gray one, which is largely through the middle, hopefully through diversification, that's approximately a 60% equity, 40% bond, commodity, real estate portfolio, you'll get a smoother ride with a lot less risk. So, and right here, looking at this chart, it's showing rolling returns of stocks, which is the S&P 500 bonds, bond aggregate, and a 60% stock, 40% portfolio from 1950 to 2024. So certainly stocks are going to be the most volatile. So if you look at a 1-year return, that green bar all the way to the left, the best 1-year period that stocks had was a 52% return, and the worst 1 year was negative 37%. So bonds, best 33, worst was 13, the 60-40 portfolio, best 34, and the worst 20%. But if we start looking a little bit longer into investing, so a 5-year rolling period, bonds, the best 5 year had 29% annualized rate of return, but a -2 annualized rate of return over the worst period. Bonds, best 18% per year, -2% per year over 5 years. However, with the 60-40 portfolio, you'll see a higher floor actually, where the worst 5-year rolling rate of return was a 1% per year, and then 20% was the best. So through that diversification, hopefully we can set a slightly higher floor and limit your downside losses. We certainly still believe that longer term bond or stocks will be where you make your most money, but that diversification again helps provide some of that floor while still allowing you to capture a lot of that upside. And right here, this is referred to a Morningstar equity style box. So in the top left, we're looking at large cap value stocks. Top right, we're looking at large cap growth stocks. So everything year to date across the U.S. equity market has been positive. The real star performers this year in regard to their respective sizes has been large cap growth and small cap growth. So the growth sector has definitely performed well in that regard. But if we look at the next slide, this is showing you growth versus value. So right here, this is referred to as a PE ratio, so price to earnings ratio, basically how much you're willing to pay for every dollar of expected earnings moving forward. So growth is that blue line, and growth stocks are more of your tech-styled stocks. Value are a little bit more tried and true dividend-producing stocks, but growth stocks certainly have been a lot higher evaluated versus those value stocks. So they're a little pricey, certainly. So we believe that value is a little more on sale right now and more fair value with regard to growth stocks. And this just breaks it out a little bit more. So the red line up top is a Magnificent Seven, and that's think company that you'll see at Alphabet, Amazon, Apple, Facebook, Microsoft, Nvidia, and Tesla. And those 7 companies make up over 30% of the S&P 500. But you can see how much those are overvalued compared to the blue line, which is the S&P 500, which includes the Magnificent Seven, and then the green is excluding the Magnificent Seven. So you'll also notice when those tariffs were announced back in April and towards the beginning of 2025, how quickly the Magnificent Seven, basically their price dropped very rapidly, which made the disparity in those PE ratios a lot smaller, but then certainly it's bounced back up quite high. So that volatility can really affect some of those larger company or those larger companies. So something to be aware of and not having too much exposure in that area. Similar thing, still looking at price to earnings ratio, but this is for large cap, which is the red, and then we've got blue is mid and green is small. So historically, large cap isn't always overvalued versus small and mid. In fact, it's been the opposite through uh, about 2004 to about 2020. But lately, large cap has definitely been more overvalued compared to mid and small. We have had questions, why do we continue to hold on to the mid and small? Because it's more on sale compared to those large cap, and there's still opportunity, we believe, moving forward in those sectors. And just another reason why we believe in diversifying across size of equities within your portfolio. Um, and right here, this is showing you returns of the S&P 500 dating back to 1980. So the bar chart is going to show you how each respective year ended, and the red dot shows how much the S&P 500 dropped intra-year from its market high. So if we look even year to date, the red dot indicates that back in April, um, the S&P 500 dropped 19%, but we're still up over 14%, and this was as of the end of September. So it's very normal to see drawbacks in each year. In fact, the average is 14%, a 14.1% drop each year. However, the S&P 500 still returns positively roughly 75% of the time. So as Greg was stating, we're expecting volatility moving forward. Seeing a 10% correction is completely normal, and we still end up positive the large majority of the time. So, and so if you do have cash on hand, we absolutely believe buying dips is a prudent way of investing. But this slide's interesting to me. So on the right-hand side, basically this is saying if you take money and invest it, the green bar represents if you put money into the market at an all-time high for the S&P 500, and the gray bars represent investing new money into the market any other day. So you'll actually notice from 6 months to 5 years, you're actually better off investing new money into the market at an all-time high. And the reason for that is because really momentum investing. So when we start seeing highs, they typically come in clusters. So a lot of catching that momentum and riding with it is why you'll actually see that your returns do better investing at an all-time high versus any other day, which is kind of contrary to the buy low, sell high kind of idea that most investors have been taught. So, and then lastly, right here we have fixed income returns, and for the most part, returns have been pretty steady throughout the year. As of the beginning or as of year to date, everything is quite positive. The primary winner has been the 10-year Treasury, and that's largely due to having the longest duration with the Fed cutting rates and interest rates coming down. The returns have been slightly better there. But you also notice that high yields and corporates have done really quite well. T-bills, as expected, are going to be a pretty steady and consistent return. But all in all, everything's really done quite well in terms of the fixed income world as well. So, and then just a few end of year reminders. Certainly, if you're of RMD age, to make sure you're doing those. If you're charitably inclined, to look at qualified charitable distributions from your RMD. Donations as well, especially with the standard deduction being so high, potentially bunching those into 1 year. Um, don't have a ton of tax loss capturing opportunities with how well the market's done, but you may own a particular position that does have losses, so looking at that. And then certainly just making sure that your portfolio is well diversified. All of these things are certainly things that we can help with. This is also October is financial planning month, so we've been sending out weekly articles and worksheets to hopefully help you kind of look through those, act as reminders. So certainly keep an eye out for those as those come out this month.
All right. Well, we definitely have some time for questions. So if you have any questions, you feel free to enter them in the chat. And I believe some questions were submitted ahead of time. Is that correct, Drew?
I do believe so. That's correct. All right, Greg, I'll shoot you one. So, do
Okay.
you believe the market will have a correction in the new year?
Well, based on kind of the evidence that Drew had covered, at some point, there probably will be a correction. There seems to be a correction every year.
Mhm.
Believe it or not, it's kind of healthy to have a correction because if markets keep going up and up and up, that just means at some point that the correction could be even bigger, depending on how quickly they've risen. Um, Over a long period of time, if earnings continue to grow, though, that does support stock prices. That's kind of the point I was trying to make. So when we talked about like those PEs and how big they were getting, there's the price on the top and then there's the earnings on the bottom and that PE ratio. So if the earnings continue to grow, that supports kind of valuations. That takes longer because those only happen, every quarter. But there's likely at some point to be some sort of a correction. It's difficult to predict when that'll happen, but typically when you get bouts of volatility, that's when you see those corrections.
All right. We kind of discussed currency, but I guess projection for the future value of the US dollar.
Yeah, that's the anyone who tells you they can predict currency movements, just make sure they're not also trying to sell you a bridge or something like that. But it did look like there was support for the dollar, kind of in the range that it's been in. So again, and if the economy continues to perform well, it's got some kind of support. I can't really predict which direction the dollar is going to move, but it does appear like it's got some support.
Another question that I'll take is how to navigate RMDs and avoid minimizing taxable when selling assets in retirement. So, certainly several ways, one of which I mentioned earlier. So, if you're charitably inclined, you can do QCDs, which can directly reduce the RMD that you have to take. Another way to go about it potentially would be doing Roth conversions. That's either before you start those RMDs or potentially even when you're doing those RMDs, especially if you're in a year where your tax brackets decrease significantly. Maybe you retired at age 65, you don't have to start RMDs till 73. Your income may be lower through that phase of life. That may be a good opportunity to go ahead, do those Roth conversions, get it into the Roth where you don't have any RMDs. That money's going to grow tax-free forever. And if you have any more questions on that, certainly feel free to reach out to us, one of your advisors, and we can help you walk through that. Another question was, are you aware of any ETFs specializing in essentially cryptocurrency stablecoins? I can take this or you can, Greg, but there certainly are a handful of ETFs or that are out there that do that. I know iShares has one, Grayscale has one. There's a handful that you can certainly invest in. Greg, you may be able to speak. Are we limited in any capacity about market or portfolio saturation, or how much?
Are you referring to, how much to put into some kind of ETF that's, cryptocurrency
Correct.
based, or?
Yeah.
I have less of a view on
Yeah.
cryptocurrency as a meaningful investment. That you can, I believe there are ETFs that can kind of get you to the areas that maybe service the cryptocurrency
Mhm.
market, kind of like a blockchain ETF or
Yeah.
something like that. So that at least you're owning a business as opposed to exactly, owning cryptocurrency itself. But we try to avoid holding, you know, cryptocurrency in our clients' portfolios. I do see a couple of questions in the chat, mostly about kind of consumer debt, and there have been some regional banks that have reported losses. Um, and is that a sign that the economy is not as strong as being reported? Should one get defensive now in anticipation of a major market correction? Um, well, I would say there should be some measure of defensiveness in one's portfolio. That would be perfectly appropriate to have on on an ongoing basis. So if you are all equity, if you are all heavy into Magnificent Seven, maybe take a look at some of these charts and um, consider that it's might be a good time to diversify your portfolio. If you're light on fixed income, consider that its job is not to make you big bucks. It's to help stabilize your portfolio and generate interest. So the diversification in a portfolio does matter because you're not really going to be able to predict um, when corrections happen. I just kind of a little bit further expanding on that thought. So let's say you do start to see the market, some data that the economy is slowing. That doesn't necessarily mean the market all of a sudden sells off, because the market could get excited that the Fed is going to cut rates, even faster. So there are other elements at play when it comes to kind of forward predictions about what happens in those events. But I would say it's important that you have, um, depending on your own particular circumstances and working with a financial planner, you have a plan of attack, you have a target asset allocation, and you have exposure to different areas of the market. I do also see a question about gold, because I did talk about gold. You know, I I would view gold as strictly as a diversifier and as a hedge in a portfolio. Certainly, it's had very strong performance this year. Um, the last couple of weeks, it's kind of traded off a bit.
Mhm.
So, not again, I don't want to be a chartist or anything like that, but gold tends to have very strong performance, and it's mostly on kind of an emotional basis, and then it's followed by periods of kind of lackluster performance. Um, if you are going to hold gold, you do it strictly as a hedge. Typically, it's a hedge versus inflation. Now, inflation, it does remain elevated, and maybe inflation does move up. So you could think of gold as potentially a hedge there. But remember, gold isn't going to generate a dividend. Gold isn't, it's simply there in your portfolio, based on kind of heightened fears or, chaos, things like that, concerns about like that. That's why you hold gold positions. So make sure it's not a huge exposure. If you've got a big exposure, you might want to consider where the price of gold is today versus where it was at the beginning of the year. I think I recall there was a question about tariffs, and the
Yeah.
idea that if the revenue generated from tariffs is used to pay down the debt, would that lead to lower interest rates? And this is an interesting question because it kind of gets to um, what's called the crowding out effect, which means crowding out means like if the government is borrowing so much money and it's issuing a lot of debt to do that, and spending too much money, eventually with all of those bonds out there, investors are going to demand a higher interest rate, and so interest rates go up. The converse of that would be, hey, if you can pay down the debt, um, that maybe that leads to a naturally lower level of interest rates. And theoretically, yes, but if you kind of look at what the run rate is on the amount of revenue generated by tariffs, so say it's 30 billion in a month right now, that seems to be about what it's tracking, so 360 billion, um, then that's a reduction of, I believe, I saw the deficit was about 1.8 billion or 1.8 trillion, this in 2025. It's not necessarily a meaningful reduction, and the national debt is around 38 trillion. So 360 billion, while big, is we still have a long way to go to kind of cut that debt balance. And also consider that it's not necessarily true that all of that money goes towards repayment, right? So it's likely that some of that money would then be spent on something else. Um, so, it theoretically, yes, but in practicality, in terms of how much money the tariffs are raising, it's probably more challenging than that. Wow, I see some chat questions, predictions about capital
Yeah.
gains tax in the next 4 years. Wow, I wouldn't venture a guess there. They I don't know if Drew, if you have any thoughts on that.
I don't anticipate them increasing with how the current I mean, the one big beautiful bill just went through. I don't believe there were any changes to the capital gains rate. With Republicans in power right now, I don't see them looking to increase capital gains rate. So again, it's hard to speculate on that one, but I'm not anticipating at least any increases in the next 4 years likely.
Yeah, yeah. Thoughts on the municipal bond market. So the analysis that I've done is, you have to be in the very highest uh, tax bracket for municipal bonds to potentially be worth your while, because
Mhm.
the after-tax yield on taxable bonds still tends to be higher than what the yields are on municipal bonds. Did I say that right? The after-tax yield on treasuries or corporate debt, things like that, still ends up being better than the yield that you get on tax exempt municipal bonds. And don't, and I would also say be very careful about going out way too long, on municipal bonds. Although with the direction rates are going in, being longer might be better, but getting out really long, you're kind of locking yourself into a muni bond. Also consider that if you are owning little pieces of municipal bonds, they're really hard to trade. That's just a practical consideration,
Mhm.
and you will take a little bit of a haircut if you try to trade that bond. So that's something to think about. Some kind of financial planning questions I'm seeing in the
Yeah.
chat. Um, any I don't, Drew, you're my CFP. I don't know if you have any thoughts on these.
Um, Again, some of them are still going back to taxes. One specific that I'm reading is regarding selling your primary residence. Um, I I'd be surprised if they eliminate it to free up the housing market. I don't anticipate it is what I'll go with, but again, I can't say that anything there for certain, but I don't anticipate that being eliminated. Um, they still have the 500,000 for for married couples to sell on the primary residence. So that's it didn't seem like there were any real changes there. So I wouldn't anticipate anything near term there.
Hmm. Okay. Were there any other pre-submitted questions?
Let me review. I guess the only other one that I'm really seeing would be just the general tariff impact on the economy. I know you kind of spoke to the debt, but just the overall economy.
Yeah. So that, when you saw markets decline in April on the announcement of those big tariffs, a lot of that was on concern that it would cause a negative, have negative consequences for the economy. And that also is why a lot of economists adjusted down their expectations for future growth and even started to increase their probabilities of recession. The idea that the tariffs can slow down the economy because they simply make things more expensive. It isn't just about inflation, but it's about, if you make things more expensive, people are going to buy fewer things, right? So if they buy fewer things and I'm a company, I'm now selling fewer things, fewer widgets, fewer services, what have you. So they they classically, the economics says that, introducing a tariff, it is a tax, and taxes, it's a tax passed on usually to consumers. And it's taxes typically have a slowing down or braking effect on consumption. So that's kind of the gist or the impact of tariffs. And what we've seen though is that the actual level of tariffs wasn't as bad as we kind of thought it would be back in April. So that kind of explains, and so far it appears that, I mean, this is just my own read, is that the level that tariffs are at right now is and it's not high enough. People, it's able to be absorbed. Although, I keep reading uh, articles and information that, food prices continue to move up, and that this is kind of getting back again to this, the dual mandate of the Fed. The reason why they focus so much on inflation is because inflation is another tax on people. And, especially for certain segments of consumers on the lower end of the income scale, inflation can hit really hard. So that's why the Fed does pay so much attention to it, and why uh, it's very difficult. They're stuck between that rock and a hard place. We got to watch that labor market and make sure it doesn't slow down too much. But by the same token, you got to prevent inflation from running hot for too long. And with that, I think we are about out of time. So, uh, well, I see one last question. So, uh, am I anticipating stagflation or deflation occurring in Q1 or Q2? I would say no to either, because one is rampantly high and we're still seeing economic growth. So stagflation, no. Deflation, we're not really seeing signs of deflation, and that would be typically in a big recessionary or depression type of environment. So that's kind of wraps up the topic for today. Stay tuned for further releases as it's financial planning month, where we've been issuing those weekly, and there are great worksheets that are included. So please be on the lookout for those, and we will see you again in about 3 months. Take care, everyone.